walk into a casino. The floors are carpeted so you can't hear your own footsteps. There are no clocks on the walls, no windows. The exits are hard to find. Every single element of that room, from the lighting to the sounds to the way the chips feel in your hand, has been engineered by psychologists, architects, and mathematicians to make sure you stay longer and spend more than you plan. Now imagine that casino fit in your pocket. And that's your credit card. And unlike a casino, you don't even have to walk through a door to get inside it. Here's the thing most people get wrong about credit cards. They think the danger is obvious. They think it's just a matter of discipline. Spend less than you earn. Pay it off every month. Simple. But that framing is exactly what the industry wants you to believe. Because if the problem were just willpower, the solution would be personal. It would be your fault. And if it's your fault, it's not their design. The credit card industry in the United States alone generated over $130 billion in revenue in 2023, not from fees charged to merchants, not from annual membership fees, from interest, from the people who couldn't pay their balance in full, from the people who thought they were using the system and discovered slowly, quietly that the system was using them. This is not a story about bad people making bad choices. This is a story about an industry that spent decades and billions of dollars making sure the math would never quite work in your favor, no matter how smart you are. Let's start at the beginning. The year is 1950. A man named Frank McNamara is at a restaurant in New York City. He finishes dinner, reaches into his jacket, and realizes he left his wallet at home. He's embarrassed. He has to call his wife to bring cash. That moment, or at least the legend of that moment, becomes the seed of the Diners Club card, the first modern charge card. The idea was simple: carry a card, eat now, pay later. McNamara reportedly said he wanted to make the wallet obsolete. He had no idea how right he would be or what that would eventually cost people. By the 1960s, Bank of America had launched Bank AmeriCard, which would eventually become Visa. By the 1970s, the cards were everywhere. By the 1980s, the credit card industry had done something remarkable. It had convinced the American public that access to credit was the same thing as wealth. It wasn't, but the feeling was identical. And feelings, it turns out, are far more powerful than math. Here's where the design starts. When you hold a credit card, you are physically holding something that is designed to reduce what psychologists call payment pain. This is a real term. It describes the emotional discomfort we feel when we hand over money. When you pay with cash, your brain registers a small but measurable loss. You see the money leave. You feel it go. When you tap a card, that pain almost disappears. Studies have shown that people consistently spend more, sometimes up to 100% more, when paying with a card versus cash. Not because they're reckless, because the brain treats the transaction differently. The money doesn't feel real until the statement arrives. And by then, the dopamine from the purchase is long gone. The industry knows this. They have known this for decades. And so the question isn't whether your credit card is psychologically engineered to increase your spending. It is. The question is what happens next when the statement arrives and the number is larger than you expected. Let's talk about the minimum payment, because this is where the design gets almost cruel. You have a credit card balance, let's say $5,000. The interest rate is 24%. Which, by the way, is now close to the national average in the United States. Your minimum payment, as listed on your statement, is around $100 a month. That number, $100, feels manageable. It's designed to feel manageable. If you pay only that minimum every month, here is what happens. It will take you approximately 29 years to pay off that $5,000. And over those 29 years, you will pay roughly $14,000 in interest alone. You will have paid nearly 3 times the original amount. For $5,000 that you spent, the card company will collect close to $19,000 total. That's not a fee, that's a business model. And the minimum payment exists specifically to keep you in that zone. Not so indebted that you stop paying altogether. Not so free that you stop carrying a balance. Just uncomfortable enough to keep making payments. just manageable enough to keep the balance alive. The technical term for this balance is a revolving balance. The industry loves revolvers, not because they're bad customers, because they're the best customers. The ones who pay in full every month are called deadbeats internally by credit card companies. They use the system and generate no interest revenue. Think about that. The financially responsible behavior, paying your card in full every month, is the behavior the industry has a derogatory nickname for. Now, let's talk about rewards, because this is the part where the design becomes genuinely elegant in a slightly sinister way. Cashback, travel miles, points. The pitch is simple. Use our card for everything you already buy, and we'll give you a percentage back. You were going to spend the money anyway. You might as well get something for it. This argument is not entirely wrong. If you pay your balance in full every month and you have the discipline of a monk, rewards cards can deliver modest value. A few $100s a year, maybe, a free flight occasionally. But here's the catch hiding inside the math. Multiple studies, including research from MIT and the Federal Reserve, have found that people spend more when they use rewards cards. The prospect of earning points activates the same neural reward circuits as winning. You're not just buying groceries, you're accumulating something. The purchase feels like an investment rather than an expense. So the reward isn't fighting your spending instinct, it's amplifying it. And the interest rate on most premium rewards cards higher than standard cards, because the issuer knows that the type of person attracted to rewards is also the type of person likely to carry a balance occasionally. The rewards get funded in part by the interest paid by cardholders who got swept up in the very system the rewards were designed to deepen. The cashback you earned on your groceries is partially subsidized by the interest charges of someone else who couldn't keep up. The whole ecosystem runs on the people who fall just slightly behind. Let's zoom out for a moment, because there's a macro story here that's bigger than any individual cardholder. Total U.S. credit card debt hit $1.17 trillion in 2023. That's a number so large it's almost meaningless. So let's put it differently. If you stacked $1 trillion in $100 bills, the pile would reach approximately 631 miles into the sky. The International Space Station sits at about 250 miles. You would pass it, keep going, and still have more stack left. That's the weight of American credit card debt. And it's not evenly distributed. The burden falls most heavily on people who had the least financial cushion to begin with. Low-income cardholders pay higher interest rates. They're more likely to carry balances. They're more likely to miss payments and trigger penalty APRs, which can push rates above 29 or even 30%. Meanwhile, wealthy cardholders largely avoid interest entirely. They collect the rewards, they pay no interest, and they move on. The credit card system, in practice, functions as a quiet transfer of wealth from people who are already stretched to people who are already comfortable with the bank taking a significant cut in the middle. This isn't a conspiracy. No one drew this on a whiteboard and cackled. It's just the predictable outcome of a system optimized for profit without guardrails designed for protection. Here's the part they don't put in the welcome letter. When you open a credit card, you are given a credit limit. This limit is not calculated based on what you can afford. It's calculated based on what the issuer believes they can lend you while still recovering the money. Those are not the same number. As your behavior shows reliability, your limit tends to rise automatically. No application required. No check-in about whether your expenses have risen too. Just a quiet increase. A little more room. Banks have found that higher credit limits correlate strongly with higher balances, not because customers make a conscious decision to use the new room, but because the room exists and humans reliably tend to fill available space in budgets, in closets, in credit limits. This is called credit limit creep, and it is entirely intentional. Your limit is not a gift. It's an invitation. And then there's the credit score, which might be the most elegant piece of the entire architecture. The credit score was created to measure creditworthiness. That's a neutral and useful idea. Banks need some way to assess risk, but over the decades, the score has been woven into nearly every corner of adult life. Your apartment application, your insurance premium, in some cases, your job application. So now the credit card is not just a spending tool, it's a prerequisite for participating in modern life. You need credit to build credit. You need a card to prove you can handle a card. And because the score rewards utilization, meaning how much of your available credit you're actively using, the system incentivizes keeping cards open, keeping limits high, and yes, occasionally carrying a balance just long enough to show activity. The credit score, designed to measure financial health, has quietly become a mechanism that requires engagement with the very products most likely to damage it. It's like being graded on your ability to handle alcohol. And the only way to pass the test is to keep drinking. So where does this leave you? Here's the uncomfortable truth that this whole video has been building toward. Credit cards are not inherently evil. Used in a specific way by a specific type of person with a specific set of circumstances, they can be neutral or even mildly useful. But the system around them, the psychology, the minimum payments, the reward structures, the limit increases, the credit score dependency, none of that was designed for your benefit. It was designed for theirs. The industry spent billions learning exactly how your brain works, how to make spending feel painless, how to make debt feel manageable, how to make their product feel like a privilege rather than a product. And they were extraordinarily successful. The average American household carrying credit card debt is paying over $1,000 a year in interest alone, not reducing their balance, not buying anything new, just staying in place, treading water. And the system is designed so that treading water feels for a long time like swimming. There is a version of this story that ends with advice, a tidy list of things you should do differently. Pay in full, set up auto pay, avoid rewards cards if you carry a balance. But that advice, while technically correct, misses the larger point. Because the question isn't just how you personally navigate a system designed to extract money from you. The question is why we've built a financial infrastructure where ordinary people need a graduate level understanding of behavioral economics just to come out even. The credit card companies are not breaking any laws. They disclose the interest rates. They put the minimum payment information on the statement. The truth is technically there, buried in the fine print of a system that spends billions making sure you never quite focus on it long enough to do the math. And maybe that's the most unsettling part of all of this. It's not hidden. It's just designed to be ignored. So the next time you tap your card and feel nothing, know that the absence of feeling is not an accident. It cost someone a lot of money to make sure you felt exactly that.